Dave Ramsey recommends growth investing as a popular financial technique. What is growth investing, and how does it differ from other strategies? Is this a plan you should think about implementing? Choosing the best investing strategy for you might mean the difference between hundreds of thousands and even millions of dollars. By the time you retire, it's usual for people to disregard the type of investments they've made, especially if they're stored in a 401k. It's a set it and forget it approach. They may not even be aware of what they are investing in or how their results compare to the wider market. Examine the benefits and drawbacks of a growth strategy to avoid leaving millions of dollars on the table. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. What exactly is growth investing? Growth investing is a technique that focuses on a company's capital appreciation and future income potential. Investors often seek high-quality, established companies with a history of quick growth and the potential to continue developing rapidly. Investors forecast the future using a combination of fundamentals and other considerations. For a relatively long period, Amazon has developed at a quick pace. Since its inception in 1994, it has risen to become the world's fourth largest firm by market capitalization. Although the possibilities of it continuing to develop at the same rate as previously are minimal due to its vast size, investors might forecast that it will still continue growing pretty rapidly. Take a look at Walmart, which is a much older firm formed in 1962, and you can see how development has halted since it's gotten so enormous. There's just so much they can do to improve earnings, since there's a Walmart in practically every community. In general, returns are higher. The single most important benefit of a growth investing approach is the high returns. Earning tremendous money is the objective of investing, right? Over a long period of time, growth investors are often able to surpass the returns of broad market funds, including even ones like the S&P 500. For example, this gives a good opportunity for younger people who have smaller portfolios that are focused on building their nest egg as opposed to conserving their capital. If you have $10,000, you're probably not too anxious about losing it, but you are focused on how you can get it to increase quickly. As investors age, they become less concerned with their returns, and stability becomes more of a priority. When someone amasses a multi-million-dollar portfolio, their goal usually becomes capital preservation. This is the reason many older individuals put a considerable percentage of their money into bonds, which are more reliable but yield small returns. Risk is generally higher, of course. It should come as no surprise that increased reward often entails higher risk. No one wants to put their hard-earned money in high-risk investments that could turn to nothing. The good news is that if you choose solid assets, the higher risk will work in your favor over time. When the stock market falls, it is highly typical for new investors to panic. They see selling as a strategy to limit their losses, but in reality, it's usually too late by the time they sell, and they may be selling at the bottom. History demonstrates that if you can stomach market volatility without succumbing to the desire to sell when things are bad, you will be rewarded. This is much easier to accomplish when you are younger, but it becomes less manageable as you become older. A 50% or more decline in portfolio value for someone in their 20s and 30s would most likely have no effect on their day-to-day lives. Because the average retirement savings of someone between the ages of 30 and 40 is just under $22,000, this would only be an $11,000 decrease. Someone approaching or already retired would most likely wish to avoid dramatic fluctuations at all costs. Could you take a $1 million or greater hit to your retirement savings? There are few or no dividends. Growth investments offer little or no income, which many investors consider to be a drawback. Companies opt to reinvest their profits by continuing to build the business, which is why there are little to no payouts. Some businesses send out large dividends because they believe they can no longer reinvest all of their profits in the business. It is instead better distributed to shareholders. This is one of the reasons why dividend and income-paying equities tend to rise at a slower pace. Like Walmart's rise, the growth of many dividend stocks has stalled. Some investors would rather the company keep the profits and invest them themselves rather than getting dividend payments and having to decide whether to acquire more shares or invest them elsewhere. Why should they seek cash when the corporation can reinvest it wisely? You could manually reinvest the dividends or use a dividend reinvestment plan, but it isn't the same as the company's board of directors focused on growth. When a corporation starts paying dividends, it is considered a growth plateau. On the other side, dividends can attract new investors, and dividends keep shareholders pleased during times of stagnant or even dropping stock prices. Growth stocks will generate substantially more money in retirement. What's particularly striking when it comes to growth investing is the difference in the amount of money you may wind up with over a career of investing. Just a 1 or 2% change in your overall returns can be startling. Take, for example, someone who begins to invest in their mid-20s with $1,000. If they invest an additional $6,000 every year until retirement for around 40 years and obtain an 8% annual rate of return, they'll have little over $1.7 million. For perspective, the S&P 500 has an average rate of return of 10% per year over many decades. Now, if they were able to get a greater rate of return by investing in high-growth alternatives and earn a 12% return for the same time period investing the same amount of money, they would have a remarkable $5,247,000. That difference of $3,547,000 might allow you to enjoy a much different lifestyle during retirement. In reality, it would provide roughly 3 times the amount of retirement income. Consider that an individual earning $60,000 per year for 40 years will only earn $2.4 million before tax. While returns vary, and many would argue that 12% isn't feasible, the point is that the returns make an astounding difference. Growth investment is maybe the best approach to produce high returns and compound your money over time. You will be rewarded if you can handle any additional volatility. Don't throw money away by investing in funds that are too conservative for your timetable and objectives. In the prior simple example, it meant a difference of nearly $3.5 million. It's easy to become engrossed in job, family, and other daily activities. However, just a few minutes spent reviewing your investments on a regular basis could imply a significantly different outcome in your financial future. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?